วัสดีค่ะทุกท่านGood morning everyone. Welcome to PSL presentation for the third quarter 2025. Today's session we will begin with industry update presented by our Managing Director, Mr. Khalid Hashim. He will provide with you the latest on the dry bulk shipping market and industry trends. Following with Mr. Gautam Khurana, our CFO, will walk us through the financial performance for the third quarter 2025 and with, later on with the Q&A session. May I ask Kun Khalid to begin?
Thank you, Song. The first slide is up for you and it shows you how China has performed in the first 9 months of this year. What I would like you to focus on is the iron ore imports. It is running at roughly the same level as last year, even though Q1 was very weak. If you look at the overall consumption of steel in China and look at the last 5-year averages, which is in the first column for you with the numbers, and then compare it with the second column, which is from 2025, you will see that actually there is growth in steel consumption, despite the fact that if you look at the last column and look at the first row, real estate was down by 25.4% compared to the last 5-year average. If you look at steel exports, it is doing exceedingly well. Just some numbers. Last year was 120 million metric tons. This year is expected to exceed that. And the other fact is that the Supras, Ultras and Handys carry all the steel exports out of China. If you look at steel exports and geared bulkers, you can see again, it is basically all carried by Handy sizes, Supras and Ultras. And you can see that global seaborne steel volumes on geared ships hit 170 million metric tons in 2024, up 14.2% year over year. And the momentum has continued in the first 8 months of 2025 with 120 million metric tons, up 10% year over year. So it looks very good from a steel export angle point of view. In terms of the Guinea, there are 2 things which you should really focus on. The first one is the first bullet point. You can see that out of the total exports from Guinea, 118.42 million metric tons in the 9 months 2025, a 40.3% year over year increase went to China. And sorry, that was the increase in Guinea, and 75% of all of this goes to China. If you look at the second bullet point, it tells you that the bauxite imports hit a record 157.6 million metric tons, up 32% year on year for China. And if you look at the last bullet point, we are telling you that the Simandu iron ore mine site in Guinea is now operational and the first shipment is taking place as we speak. If you look at the US-China maritime trade truce, it's for 1 year. I won't go into the details here because there are not that many details announced yet, but basically there is a stop from further escalations, and the escalations agreed by both the parties, China and US, have both been removed. Dry bulk trade and tariffs. If you look at this slide and look at the 9-month exports of dry bulk cargoes from China, it reached 150.8 million metric tons, and that is just 3.6% of global dry bulk exports. So China is not a big exporter in dry bulk, but it does export a lot of steel. As I said, last year was 120 million metric tons total for exports, and we expect more this year. If you come then down to the 4th bullet point from the bottom, China imported 2.3 billion metric tons or 42.2% of global dry bulk imports last year. The second best was 7.9% for the European Union, which is 27 countries put together, and India was third best at 6.8%. If you look at the 9-month performance, which is the bullet point above that, you can see that China imported 1.6 billion metric tons or 40.7% of global dry bulk imports in the first 9 months. European Union was second at 8% and India was third at 7%. So if you look at the second last bullet point, you can see that whatever in US is exporting to China is all goods that can be got from any other country. And so obviously, if there is a real tariff war, it can only hurt the US and certainly not China. Of course, you all know this, the decarbonization plan that was being proposed by the IMO and agreed upon in April, in October was shot down because there was solid pushback from the Trump administration. And what we have seen is that this vote is now put back by 1 year, within which time IMO is going to try and once again lobby for getting enough votes to put it across the line. Frankly, with America being against it, I doubt very much if anything is going to change during Trump's regime. If Trump actually steps off the president plate, then we will see some changes that might take place, but not otherwise. If you look at the grain exports, it's expected to grow by 3% from 729.4 million metric tons up to 729.4 million metric tons, up 21.4 million metric tons, or up 3% year over year. These are slides which we show you every time about the billion ton miles that Clarksons are forecasting. And you must remember that they keep revising it. They begin with a negative number in about a year earlier, and then they go to a positive number by the end of the year. And then by the year after, in the first quarter, they actually come to the real level that was used or was created in demand terms in the dry bulk space. Same thing with the minor bulk trades. Now, I want you to just focus on this slide on the first two bullet points. So the first bullet point, you have that growth in global minor bulk trades in the first 9 months of this year was 4.7% year over year, compared to an average of just 4% since 2020. If you look at the second bullet point, it tells you that ton mile demand grew by 8.1% year over year. So as an example, if you were to look at the ton mile growth in minor bulks, and if you look at even on major bulks and look at just grains and look at the grain import or expectation for this year, it is nowhere near 8.1% as it is shown in the slide that I've got for you. The rest are all details of what I've told you in the first two bullet points. If you look at this, it gives you where the ships are spending their time, the different types of ships. And if you look at this and focus on the ones where PSL has outperformed the rest of the world fleet, you can see that in steels, we are 3.3 times larger in terms of exports of steels. If you look at fertilizers, again, 1.6 times over and above what is the norm for the industry. And if you look at other ferrous, we are again 1.6 times larger than the world fleet. But otherwise, we are equivalent or smaller. In wood, we are up at 2.8 times. If you look at the total growth in tonnage and look at the last two slides, it says that last portion, the last two columns on the bottom part of the slide, you can see that the geared sector grew by 13.36 million deadweight metric tons. And if you look at the gearless, it was up by 11.19 million deadweight tons. And total was 24.55 million deadweight tons, or 2.39% of the world fleet. If you look at this slide, it tells you that the total order book is at 109.58 million metric tons as of the 1st of October, or 10.4% of the existing fleet as of the 1st of October. And if you compare that with the 20-year-old fleet, which is at 10.84%, you can see that it's consistently overage ships are more than the ships on order. And if you compare it with what's happened in the past, you can see clearly that the order book was always much, much stronger than the 20-year-old fleet. And the 20-year-old fleet is now starting to creep up again towards the levels that were there in 2006, 7, 8. This slide shows you how the BDI has reacted in the first 9 months and compares it with the last 3 years. It also looks at the number of ships ordered in deadweight million tons, how it has compared with what was ordered in the past. And you can see in all cases, it was highly negative. This year, people have not ordered many ships. If you look at this slide, it tells you what's happening and what else is constraining the availability of ships. And here we have special surveys which are forcing many ships to stay idle for long periods of time. And just look at the absolute numbers. If you look at bullet point number 6, it tells you that in 2024, we lost 1.7% of the entire supply in the geared sector just for special service. And if you look at the slide at the bullet point above that, number 5, you can see that there was a decline or expected projected decline of 2.3% in 2025 and 2.2% in 2026 due to special service. So we think that supply is going to reduce because of these numbers. The other one to keep in mind is what is known as engine power limit or EPL. This is a flow through from the EEXI compliance. We've just simply looked at the PSL fleet and saw how many knots of speed have we been asked or rather forced to reduce by based on our fleet, and it's 1.5 knots. The math is very simple. It's there in the lower portion of the slide, and I've shown this to you before. But what is more interesting is that if you apply that 1.5 knots to the world fleet, you will find that 3.5% of the world fleet in the geared sector is going to be slowing down to this extent that they will reduce supply overall in the dry bulk fleet by 3.5% every single year from now onwards. Again, and also keep in mind that we have a 2.3% reduction because of special surveys. So the total loss for this year from the supply side is going to be a massive 5.8%. So if you look at the key industry takeaways, IMF has raised the world GDP growth rates. China's GDP growth rate is progressing at about the 5% mark. Ton-mile demand is forecast to grow by 1.3% in 2025 by Clarksons. It is a very misleading figure. It's going to grow much more strongly than that, as I've just shown you on one cargo that is on grain. If you look at coal exports, they rose 5.6% year over year in August for the first time since November 2024, led by very strong Chinese demand. And we are seeing that same Chinese strong demand flowing through in October, November, and December. China's fixed asset investment was 3% in 23, 3.2 in 2024, but shrank by 0.5% year over year in the 9 months of 2025. The fleet is forecast to grow, the geared fleet is forecast to grow by 3.1% in 2025, but net effective supply is going to be much lower. As I've said, about 5.8% of the existing fleet will be reduced from the total numbers in 2025 by the two factors, special surveys and EEXI EPL application. Net effective supply loss is going to be quite a lot, 5.8%. And against that, you've got fleet growth of 3% this year and 3.2% next year. So I think we are okay in terms of the supply side. Forward order book to fleet ratio at 10.4% is less than the 20-year-old fleet at 10.84%. And disruptions continue. Supply-demand balance continues to improve. So what has been our strategy? Our strategy has been a simple strategy that we will sell the older ships. We've already sold 4, and we will replace them with much younger, larger units. Therefore, our grams of CO2 per ton mile of cargo carried will continue to reduce. And now Gautam will take you through the financials of the company.
Thank you, Khalid. So here are some highlights of our Q3 results. So we reported a net profit of $7.78 million, or a gain of 0.17 baht per share. EBITDA came in at quite a healthy $21.36 million. We continue to pay consistent dividends. We paid interim dividend number 2 for the year 2025, 10 satang on 5th of September. During the quarter, we acquired 2 Ultramax bulk carriers. We took delivery rather of 2 Ultramax bulk carriers on 7th of October and 15th of October. Incidentally, we just announced also on Friday that we have purchased 2 new building Ultramax resale vessels, also similar size, 66,000 deadweight, which we will take delivery of within the next, maybe the next 2-3 months. In terms of financing, so we signed an amendment agreement with Krung Thai Bank. So we raised an additional 6.37 million. And in terms of employment, so we have 7 ships, including these 2 ships, Usani Nari and Urairat Nari, which are on long-term time charter contracts at fixed rates. And when we say long-term is defined as 1 year or longer. And then we have 16 ships which are on long-term time charter contracts with rates linked to the underlying index for vessels of their size. Just in terms of our investments, so we are an investor in a Singapore company called UniAsia Group. We hold about 6% stake. There was no change in our shareholding during Q3. And we also are a shareholder of a company called VL Enterprises. This is a small coastal tanker operator in Thailand. We own about 22%. We bought a little bit during the third quarter. We carried out a share repurchase program this year, which ended on 29th of August, and under which we acquired about 74.59 million shares, so at a total cost of 451.93 million baht. Average cost we acquired the shares was at baht 6.06 per share. So Khalid has already gone through the vessel acquisitions and disposals. So just one additional thing to mention is so we've got these 4 Ultramax vessels that are delivering from Sanfu shipyard. We already announced them. What is not yet updated on this slide, as I said, are the 2 additional new buildings, which we just announced after close of market on Friday. So that would take our fleet up to 48. So just on key figures, revenues for the quarter came in much stronger, 44.6 million compared to 36.6 million in Q2. Net profit was up, earnings per share was up to 0.17 baht. Return on equity was positive, 1.28. The net debt to equity ratio has remained fairly stable. We've been raising debt, of course, but we've also been repaying debt equally. So, okay, so in this top left graph over here shows you the TC rate per day in US dollars, the average rate that our ships have earned for each quarter. So you'll see that the third quarter was the strongest quarter we've had in the last 5 quarters. We started off the year at a very sluggish pace. Markets were weak because of the compressed period between the Western New Year and the Chinese New Year, as a result of which Chinese industrial production activity was down, but that recovered. And so rates are quite strong now. And EBITDA, as a result, was also quite okay at 21 million. We continue to pay dividends consistently, and we've maintained a healthy cash balance. So at the end of the third quarter, we had 49 million of cash on our balance sheet. So this is a statement of financial position, so our balance sheet picture. So you'll see that we had, in terms of book equity, we had 469 million. Our total loans and debentures, 288 million. Cash was 49, and total vessels and equipment, 658 million. So this is at the end of the third quarter. Of course, this picture keeps changing as we are in the process of selling off our older ships and acquiring younger ships. This is the cash movement in Q3. So we began the quarter with 30 million of cash, generated 27 million of cash from operations. CapEx, so really payments towards 2 things, dry dock and also some payments towards acquisition of vessels. That's 22 million. Finance costs have remained fairly stable, 4 million, and we took loans 35 million. And we ended the quarter at 49 million. So loan movement. So at the end of the third quarter, we ended up with 246.5 million. We drew down loans of 67 million, repaid loans of 28.3, and we still have some outstanding facilities available to us, notably the IFC Kasib Exim Bank facility, which we will plan to use for some of our new buildings. We also have another facility, actually maybe 2 other facilities, which are currently there's a lot of other facilities in the pipeline to meet our growth requirements, our financing requirements. So here is the operating expense analysis. So you'll see that at the end of the third quarter, our average OPEX was 5,284. slightly up from 5,135, but still actually quite a bit below our budget, about $300 below our budget. And costs have remained fairly stable. So crew costs have remained stable. Slight increases in dry dock and special survey because we had a number of ships that underwent dry dock in the second quarter, some in the third quarter. So our operating expenses continue to be quite a bit below the average industry operating expenses, about $500 specifically, and every $100 in savings here translates to about $1 million on the bottom line at the end of the year. We had a surge of ships that underwent dry dock in the year 2025, a very unusual surge. So a full 11 ships in Q2, and that in no small part contributed to the poor earnings that we had in Q2, and that to some extent continued into Q3, and now that's tailing off. In Q4, just 4 ships are undergoing dry dock, so they're available for trading and to earn money for us. And in 2026, we have a more normalized year, so there's only 11 ships in the entire year that will be undergoing dry dock. Now, if you look at this, actually, as this is an industry-wide issue, so there's across the industry, dry bulk. Many of our peers have actually a number of ships that are undergoing dry dock in both 2025 and 2026. For us, it was a bit front-loaded, so most of the ships that underwent dry dock underwent it in 2025. So here we compare our operating expenses and G&A to some of our listed peers in the Supramax, Ultramax sector. So this is data for Q2 2025, and you'll see that our OPEX and G&A is lower than our listed peers. And not only that, so when we look at EBITDA per ship, we actually outperform our peers. And I think the more important figure to look at is the last 12 months EBITDA per ship, and you'll see that we have outperformed our peers. So our revenues, less expenses, are higher on a per ship basis for the Supramax, Ultramax sector. This is our debt maturity profile. So you'll see that it's fairly flat. We don't have any major balloons, any major maturities coming due until really 2028, 2029. And we are generally pretty proactive. We will finance in advance or refinance in advance all our facilities that are coming due to de-risk this. Okay, so this is our net debt and net debt to equity ratio. So I would say we are still at quite a healthy level. The net debt to equity ratio is 0.5. The net debt is 239. Of course, you saw a higher figure when you looked at the total debt, but you consider our cash position, the net debt figure comes down quite a bit. So still quite a healthy figure compared to the size of our balance sheet and our total book equity that we have on our ships. Here, this is the industry average OPEX and TC rates. I leave this as a reference slide. Dividends, we've been paying dividends consistently, as I mentioned. Our policy is to pay not less than 25% of net profit as dividends, and which is what we've been doing. I'll leave this as well as a reference slide. This is a lot of data here. Shareholder returns, just one thing to mention. So if you were an investor in our stock during the IPO in 1993, and you held on to our stock until today, you enjoyed all the dividends in the interim, you would have earned a 15.63% IRR on your investment based on most recent stock price. And that compares quite favorably to many of our peers, our dry bulk listed peers, all of whom have actually lost money for their shareholders, as you will see. And this is not us saying it. This is a publication called Splash 24/7 that had analyzed all the different dry bulk companies that is saying this. They did this analysis. What they missed out is, this is all US listed companies, and they missed out PSL in their analysis, and had they included PSL in their analysis, they would have known that a 10,000 baht investment in PSL at the IPO would be worth almost 1 million baht today. Okay, so here's some investor relations data. I'll leave this as a reference slide. Okay. So here's a lot of ESG data, which again, I think I shall leave this as a reference. Maybe just one thing to mention. So we're ranked in the top 12% of global listed transportation companies in S&P's corporate sustainability assessment rankings. This is their global ESG ranking, if you will, for all transportation companies. And Morningstar has actually put us even higher. So they put us in the top 8% of all global listed shipping companies in their ESG risk ranking.